I'm here with Lior Gantz, founder of wealthresearchgroup.com. Lior, how's it going?
Going good. Thank you for having me.
Hey, I'm going to put some information down in the description so people can check you out and check out your .com down there. But I have some questions for you, and it relates to the current market on gold and silver. It's coming down. A lot of people didn't foresee this. They thought it was going to continue to climb. I'm just kind of curious on your thoughts about what might be going on there.
Yeah. Well, we have a higher for longer narrative that's becoming more consensus. And higher for longer means higher interest rates for a longer duration. The initial consensus was that the Fed will raise, solve the inflation problem very easily, because they initially said, hey, it's just supply chains. We're going to definitely handle it. It's under control. Let's jack up interest rates and we'll be done with it. We'll be back to our long-term trends because of technology and globalization and whatnot. And then in the middle of doing that, you had Putin invading Ukraine, changing the entire dynamics of the energy market around the world, and a lot of other commodities for that matter. And then you had a really interesting phenomenon happening with baby boomers who just don't care that wages are going up and that there's a lot of availabilities for jobs. They are out. And so they are retiring in mass droves. And when they retire, they not only, they not only quit, but they also sell their stocks. They sell a lot of bonds, and they move it into either very short-term treasuries or to cash. And so you're seeing at the same time a lot of different things happening. Some of them happening for the first time in 80 years. And so if you want to solve this inflationary problem, you have to keep rates higher for longer, especially because of the labor shortage, and especially considering that the CPI obviously understates real inflation. So we know this, the media knows this, obviously Jerome Powell and the other governors know this because they're getting presented with every sort of inflation measure that he probably tells staffers, exclude this, input this, exclude this, and they work out all these different things to look at inflation. They work with the CPI and the PCE on the public realm, but when they do their own thinking, I'm sure that they look at everything piece by piece and try to figure this out. So the answer to why gold and silver are correcting right now is because we are not sure, or the market isn't sure, what will happen after June. It is pretty convinced that in March, we're going to raise by 25 basis points. In May, we're going to raise by 25 basis points, and in June. And that will get you to 525 to 550 on the Fed's fund rate, which is a lot. It's higher than the historical averages. It's very tight. You are doing this at the same time as you're reducing the balance sheet. So you're doing a lot to kind of stop inflation and lower the amount of capital circulating in the banking system and in society. And then you're also limiting the amount of money that the government can rationally and reasonably borrow, because now come real interest rates with it and not zero interest rates. So with all that context, you look at what's called the tips or the break-evens. The break-evens or the tips are inflation-protected bonds, and those are basically designed to see what real interest rates are in the economy. In other words, interest rates after you adjust for inflation and currency exchanges. And right now, they are positive almost across the spectrum. In other words, if you're an institutional investor, you can buy a 2-year bond, a 3-year bond, a 5-year bond, a 10-year bond, a 15-year bond, a 20-year bond, a 30-year bond, and actually get a after inflation adjusted return that is positive. And that's not the world we lived in for the past 3 years, when gold actually rallied twice over 2,000 an ounce. So now the question on everybody's minds is what happens after June? Because if we have a recession, for example, I would say if we have a situation where the Fed starts to cut, then gold will rally a lot. Gold is the best performing asset class historically in recessions. If we avoid a recession and have a mild landing, or what we call a soft landing, then gold may hover around these levels for years, or for a year, etc. And if inflation stays stubborn, but the Fed has to cut because of other agendas, then, or just keep it as is, which means we've hit peak interest rate hike, then gold will start trending higher as we anticipate that at some point the Fed will cut. In other words, if we know that the Fed has ceased from raising, that will ignite the uptrend for gold, but not until then. So it could be that between now and June, it fluctuates. It's under the speculation of what will happen in the June meeting, whether or not we will actually get an answer in the June meeting. Maybe the Fed just raises by 25 basis points and says, hey, we're open to more. We don't know. So that's where I'd say gold is kind of trading at. Now, just to finish this up, central banks, especially foreign central banks, obviously, have bought record amount of gold last year in 2022, the most amount on record. So you are seeing a huge shift in the preferences of other governments and central banks, whether or not they want to buy U.S. debt, treasuries, or do they want exposure to an international form of money that's not tied to the U.S. government. And it looks like they're divesting out of the dollar, and that trend, to me, is going to continue for at least the next 5 to 7 years. And that's a great backwind for the prices of gold in the longer term this decade. Yeah.
You know, there's a lot of information out there, and anybody can go look it up on how these banks have been buying up gold. It's actually kind of interesting to see that. And a lot of the talk has been going on very recently about that. You know, for some people, they say the recession is already here. It's been here. I don't feel like it's a total recession as of right now. We're still, able to function. People still have, a lot of jobs, and it's not so terrible yet. But what would take us to that breaking point to where we really have like a recession? Let's say 2023 is the goal for a recession. Like, what would take us there if we ended up having that?
Well, first of all, that's not my base case. I don't think that we're headed into a recession in the United States. But I would say that, to me, what could send us into a bad recession even is if in May and June, the Russians and the Ukrainians have a very bloody battle on their hands, and things escalate. So things can escalate in two ways. One, the Ukrainians can surprise and actually get the Russians to retreat, or give them a lot of headaches, and then it's going to be interesting to see what the Russians do in return, because they can't lose. In their minds, this is not something you can negotiate. Same with the Ukrainians. But if the Russians do advance, then their appetite certainly will grow, and they will go after other countries next, other NATO countries, and that will escalate and send the world into probably something that's worse than a recession. So I really hope that we're able to manage that situation, the international community. But if we can't, then that's the biggest issue on my mind. And so that's why, even though my base case is not a recession, or maybe just maybe a mild recession in pockets of the economy, but not a full-blown recession. I still am not fully invested in the markets and in housing, etc. I'm very patient and looking at what I want to own over the long term, and when I decide to add more to those positions. Now, if you go to wealthresearchgroup.com/portfolio, you can see my entire portfolio. So you know exactly what I'm doing. I have a portfolio of 40 to 50 companies that I update very rarely, but I add about a company to 2 companies a year. I have very strict limits that I'm willing to pay, and that's what I'm doing. I'm waiting to for the companies that I love to get into those price ranges, and then I add to them. That's in the stock market. I do think that if you look at what could actually take us out of a recession or a recession scenario, is if we have a speedy recovery in Europe, and actually is not looking bad at all right now in Europe. It's looking really good after a nightmare in the UK, in Germany, etc. But we are definitely in on the bigger picture, we are in a 5-year reset of many things in the global economy, be it the role of the U.S. military Navy, be it the role of China in manufacturing goods for the rest of the planet, obviously the role of Russia in creating the scenarios that allowed Germany to be an industrial behemoth, and those things, as they're changing, they are big events, and obviously interest rates play a huge part in the advancement of tech companies and how much they're able to hire, etc. So I see a lot of people that are not going to be living in the same living standards as they did in the past decade in the tech community. And I also see a problem with growth in general, because the richest generation of all time, the baby boomers, are going to be way more reluctant in retirement to put their money in the markets, in equities, with a financial advisor, with funds, etc., etc. They want to be in cash because they've seen 2008, they've seen Brexit, they've seen the tariffs in 2018, and the bear market at the end of the year, and they've seen the March 2020 panic. So all of these things are huge changes, and they will take about 5 years to take place, and then we have literally a new world in many regards.
So, you said the baby boomers are selling out, they're retiring, they're kind of liquidating so they can hold cash. And you mentioned yourself that you're being very patient right now. This is not a buying opportunity when there's so much out there and the prices are coming down. You don't think the opportunity's quite there yet?
So the answer is no. I don't think it's a bargain stock market or a bargain real estate market, and that's because we're not in a recession. We went to a very expensive, overvalued bubble, and we've come down to something that's still historically pretty expensive. So while I'm 38, going on 39 in July, and I'm going to be a net buyer of assets for the next 25 years. So of course I'm going to be buying assets. No, it's not. This is not a classical recession. You don't have 10 to 15% unemployment, huge bankruptcies everywhere, foreclosures. In fact, personal bankruptcies are an all-time low right now. As you know, there are more job openings than people applying for jobs. So we're definitely not in a recession at all. We are coming down from a very we're coming down from from the hangover, but we're going back to sober. It's not like we're over here on the floor and and it's bottom basement prices for assets. I don't think that's the case at all right now.
All right, very good. And silver shortage. Let's talk about that for a moment.
Okay.
I never had a too difficult of a time, except for maybe a few years ago when the prices of silver dropped down to $11 or so, 11.30 an ounce. Became a little difficult to find stuff online. Some of my local places still had silver, but they were charging like 18. They wouldn't go close to the $11, spot price. What do you think is this silver shortage, kind of the rumor going around? What's happening with that?
The disparity between the amount of silver on the LBMA and the COMEX, compared to the amount that's trading, is always at a huge leverage. Now that's true not just for silver, but for all other commodities. In silver, and that's part of the financial market's way of hedging. I'll give you an example. For if China wants to build a huge project and it needs a lot of silver in the next 8 years, it will go to the futures market and hedge their purchases in the futures market. And so because they're hedging 8 years ahead, of course, there's going to be more trading on the futures and derivatives than there is physical silver right now available for purchases. So there's always a big leverage. Now, a normal leverage in other commodities is speculated to be around 25 to 30 to 1. Okay. In silver, it's speculated that it's about 250 to 1. So it's the idea is that because the leverage is so ridiculous in this particular commodity, plus the size of the market that's very small for silver, plus the 4 very concentrated short positions that JP Morgan and 3 other institutions have, create this dynamic where you can have a silver squeeze if only everyone started to buy even 1 ounce of silver. And that's where this thing is coming from. Now, silver, because of the Hunt brothers, who at the height of their stacking got to a situation where they warehoused about 1/3 of global silver supplies, and obviously had to unwind it on request of the U.S. government through the court system in 1979, and then this whole thing went on till 1988, their proceedings. And then you had in 2011 the court cases with the CFTC and whatnot, regarding all sorts of trades by Deutsche and by JP Morgan, Lloyd's, and Barclays, and traders doing spoofing. This is all public information. And actually, I put together like a chronological summary of the whole thing. If you go to wealthresearch.com/COMEX, COMEX, then you can understand like the whole shenanigans. That's where this idea and notion originates from. Now, if there is dwindling inventory of silver on the COMEX, and there is right now, then there are mechanisms in place to offset these shortages and to create settlements in cash in case there's like a mini squeeze on the supply, if everybody all of a sudden starts to request their futures come to them in pallets or whatever else. So I think that's where this originates from. Obviously, there is a shortage. The word shortage is kind of ambiguous. We are basically at the same levels we were in 2001. So I would say that's interesting, right? Because that's the start of the biggest bull market we had for silver. And if you think of the reasons why this is happening, it's because of deglobalization and countries looking to source very reliable supplies of essential materials. Before before globalization, if you didn't have essential commodities on your in your country, you were probably part of the colonial system, and you were occupied. And globalization freed the world to trade with each other, so that countries with no essential raw materials could be part of the global economy if they can service other sectors. But now we're going back very fast to a world where if you don't have what you need to source, then you better realize who your allies are, because obviously what happened with Russia, what's happening with China, and this is a big problem. And I think that plays into these dwindling inventories on the COMEX.
Gotcha. Now, I'm not totally one for predictions, and it's hard to predict something like the silver and gold market in the next few years because it's based off of a lot of things happening.
Especially if you're trying to predict the future. That's the hardest.
Absolutely. But let's just play around a little bit. What's your gut feeling on silver and gold in the next 5 years?
I've been asked this question a lot, obviously a lot. I think that the way to look at it is not what would be the nominal price of gold and silver, but what would be the nominal price of gold and silver compared to other assets. In other words, many times we compare silver to other times when silver traded higher or lower, etc., and gold the same. What you want to look at is how many ounces of gold or silver buy you one share of the S&P 500 or one median family home, a single family residence, etc., etc. What you want to see is whether or not your savings power, that's what gold and silver are, forms of savings, if they are increasing in value relative to other assets. And in the 21st century, for example, if you plot gold and the S&P 500, gold's actually outperformed the S&P 500 for 21 years. That's a lengthy amount of time. So when we look at the long-term outlook for gold and silver, especially now when the world is kind of deglobalizing and the need to hold US debt as a foreign country is diminished, I think that you are gonna see higher gold and silver prices. In general, during the fiat monetary system of the past 51 years, gold is a much better accumulator of wealth than silver. Gold is compounded at about 6.8% a year for 51 years, and silver at about half that, 3.4%. So if you're looking to create a trade, silver is way more volatile, and if you catch a good one, then my strategy has always been to sell those gains and to buy more gold than I could have originally if I hadn't done that trade. I use silver more as a trade and gold more as the underlying savings mechanism that I like. And so if you're asking me like where their prices are going, I think that in general, their prices are going higher. And I think that their prices are going to go higher and in better clips than real estate and probably the indices for at least the next 2 to 3 years. So that's also plays into how you should invest. Because if you're just investing in the general market and buying like a large index fund, I think that can go nowhere for the next year, 2 years, maybe even 3 years. And same with a home, an investment property. So keep that also under consideration. And lastly, when you want to compare apples to apples, compare gold and silver to the DXY. What would have happened if you were long the US dollar during the next 2-3 years? And that's where I think the power of gold really comes in, because you need to compare it to other forms of cash. And I think that if you look at what's coming in the next 2-3 years with the Fed drastically reducing their balance sheet, and with way the interest rates are going to stay higher, and the demand for dollars is going to be less and less, vice versa to what, or in stark opposite to what happened in the last decade when U.S. debt was purchased at zero interest rates. I think that leads me to believe that the DXY is going to go towards the mid 80s, and in that scenario, gold and silver, especially silver, really flourish. So I have no idea what price they can go to. Have you ever seen I've lived through the 2011 mania, so believe me, I woke up one day, it was 31, the following day was 34, then 38, 42, 45. It's insane. So you just don't know.
Right on. And that's very fair. Now, on your website, wealthresourcegroup.com, and I'll have a link for that down in the description. Before we go, tell people what they can expect there if they go to that website.
Actually, it's called the wealthresearchgroup.com. And the flagship newsletter is the best thing to follow if you're just looking to know exactly what I'm thinking about in terms of the macroeconomics, geopolitics, the economy, stocks, and whatnot. I also share a lot of what I'm doing with my own portfolio, etc. And that's, if you just sign up on the homepage, that's a free newsletter. Otherwise, if you look at the top tabs, there's one that's called Special Reports. That's one where you can kind of access a lot of great information, downloads that we put out, and have a good time reading them and diving deep into topics such as CBDCs, for example. We put out a 2-part series. It's called wealthresearchgroup.com/CBDC and /CBDC2, the number 2. And it goes into the pros and cons and threats and why it's so hard to implement that. We've also put something together about World War III actually starting in space already, between China and the United States. And that's the ultimate frontier. So if you haven't checked that out, I think that's really an interesting one. That's wealthresearchgroup.com/space.
Right on. All right. So very, very good correction. Wealthresearchgroup.com.
Yes.
Thank you very much. Good to have the right info. And of course, I'll have the right info down in the description of the video. Lior, very good to have you on and get your information. I think it's important for people to see, what's kind of going on out there and put some thoughts in their head. And it's good to also have a website like the wealthresearchgroup.com that people can go and kind of see your thoughts more often. And if I could have you on the and maybe in a little while, a few weeks or months or whatever you have time for, so that we can kind of reconnect and kind of see where the world is going.
Yeah, definitely. A great time would be after the June meeting. We would know a lot about what's happening in the Ukraine, and of course what the Fed is thinking. So I think just in general, for your viewers, mid to late June could be a key pivotal point in this war and in the war that the Fed is waging on inflation.
Right on. Lior, always a pleasure. I have other videos where Lior speaks about, just what you're hearing now, what's going on in the world, gold, silver. So check those other videos out. And also down in the description, check out wealthresearchgroup.com and make sure you check out what he's doing over there. And like he said, you can see his entire portfolio and kind of the moves he's making. So Lior, thank you again for coming on, and appreciate you. And hopefully we can do this again soon.
Thank you. Likewise.
Well, hello, everybody. I seek to educate and entertain through my journey of collecting coins and stacking precious metals. I encourage you to subscribe, and please stay with me on this journey. I am Spegtacular, the Silver Stacular.